What's heavier than a Monday morning after a long weekend? The weight of the Fed rate cut expectations hanging over the market. And trust me, that's heavier than your gym squat rack. So before you place your next trade, watch this. I'm Francois, your market analyst here at ATFX Africa, and welcome to today's daily market brief. We've got a busy week ahead with key inflation data, central bank updates, and of course, the usual roller coaster ride from the markets. So let's get into it. So before we get into the technical analysis and some of the more in-depth fundamentals, let's have a look at what is in store from an economic calendar point of view for this week. The week is, well, digesting last week's weaker than expected US employment report, which has strengthened expectations for further Federal Reserve rate cuts before year end, maybe even two of those on the cards. While the calendar looks, well, lighter compared to last week, several high impact events are lined up for, well, what could spark some significant market moves. The spotlight will fall on the US inflation data, with both CPI and PPI releases likely to guide Fed policy expectations. Meanwhile, the European Central Bank's latest rate decision will be released on Thursday. And well, will this be another key driver? Well, we'll wait and see as investors look for signals on how long the ECB plans to hold rates steady. Geopolitics also remain at the background for, well, other risk factors, ensuring markets may not stay quiet for long. Looking at the economic calendar for today and tomorrow, a relatively calm start with Chinese loan data and comments from the Swiss National Bank that could likely influence the euro and the franc. On Wednesday, the action kicks up with Chinese CPI and PPI releases, followed by US PPI and weekly crude oil inventories, keeping energy and inflation sensitive assets in focus. Thursday, the busiest day of the week, is the ECB rate cut call and US CPI drop within minutes of each other, alongside US unemployment claims. The ECB press conference later in the day will be closely watched for policy guidance. And then on Friday, the week closes with UK GDP data in the London session and US University of Michigan consumer sentiment and inflation expectations. Though markets may see a quieter end compared to, well, the NFP driven volatility from last week, overall, while the calendar is not as packed, the quality of the data and central bank updates mean traders should prepare for volatility, particularly from the midweek onwards. Now let's dive in deeper by having a look at our top three setups for today, kicking things off with USD CHF, which is trading near 0.797, with the dollar slightly losing ground at the start of the week. The Swiss National Bank remains the primary focus. After cutting rates earlier this year, Swiss National Bank has hinted it may be nearing the end of its easing cycle, as inflation in Switzerland has stabilized close to 1.3% year on year, comfortably below its 2% target. This reduces pressure for additional cuts. On the US side, the Federal Reserve policy stance is keeping the dollar supported. While markets expect potential rate cuts later this month and another one potentially next month in October, US inflation data this week could either reinforce or challenge those expectations. Risk sentiment is also another driver. As traditional safe haven currency, the franc often strengthens during market uncertainty. With global equities holding near all-time highs, safe haven demand has been muted, favoring the dollar in the short term. Having a look at the charts, the pair closed under 0.8, losing its grip on the 50-day moving average. Players now have their eyes on the 0.795 and then July's low at 0.7911. For the bulls, well, you'll need to reclaim that 0.8 level first. and only then can you dream of the resistance at 0.806 and potentially higher at 0.815. Right now, though, momentum clearly favors the bears.
Why is fast trade execution a must? Because you're more likely to get the entry price you want and the exit price you want. Reliable, rapid, responsive. Join ATFX today and let's get you started.
Moving over to silver, which is currently trading around $40.60 an ounce, consolidating after last week's volatility. Silver benefits from a dual role as both a precious metal and industrial commodity. On the precious metal side, demand is influenced by interest rate expectations and the dollar. With the Fed rate cut bets growing, silver has enjoyed some support as lower rates tend to weaken the dollar and boost non-yielding assets. Industrial demand remains a powerful driver as well, especially with silver's critical role in solar panels, production, and other green technologies. Global investment in renewable energy continues to expand, underpinning longer-term demand. ETF holdings on silver have been relatively stable, suggesting investors are cautiously optimistic but waiting for clearer direction from the Fed and inflation data. If US inflation surprises to the upside this week, it could pressure silver in the short-term run via a stronger dollar. Conversely, softer inflation could likely provide a tailwind. Having a look at the charts, after smashing through $40.50 last week, silver cooled off slightly and dipped to around $40.65. The bulls, however, are still in control, but with $41.40 remaining as the ceiling to watch for now. On the downside, $40.50 is now your immediate support. Break that and $40 comes back into play. For now, however, the white metal looks like it's just catching its breath before its next leg. Let's finish things off with the Nasdaq 100, which is consolidating 23,700, showing hesitation ahead of major economic releases. The Federal Reserve remains the central focus for this specific index. Market is currently pricing in or suggesting that there's a probability of a 91% rate cut now in September and an additional 72% probability for another rate cut in October. But Fed officials have been cautious in commenting, emphasizing the need for more disinflation evidence. Corporate earnings have been robust, with mega cap tech continuing to outperform. However, valuations are stretched, and any hawkish surprise from the Fed could weigh disproportionately on growth stocks. The AI boom continues to support semiconductors and cloud-related names, helping offset weakness in smaller tech firms. Additionally, US bond yields remain a critical factor. The 10-year Treasury yield is anchored near 4.2%. A sharp move higher could trigger rotation out of equities into fixed income, while stable or lower yields would underpin the rally. Geopolitical tension remains at the backdrop, but for now, US tech leadership is intact, keeping the Nasdaq 100 supported unless macro data shifts sentiment later this week. Having a look at the charts, this index is currently trading around 23,700. It has bounced modestly but remains stuck in its broader range. Resistance currently sits near 23,850, and a break above could open the door to retesting record highs. On the downside, 23,450 is holding as key support. If that cracks, 23,000 becomes the next checkpoint. With CPI just days away, volatility risk is brewing nicely here. So, will the dollar's losing streak continue, or will Thursday's CPI flip the script? Tomorrow, we'll dig in deeper into how inflation expectations are shaping the Fed's September decision. And trust me, you don't want to miss that. But with that, we wrap up your daily market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to ATFX Africa by clicking in the link in the description and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.